A new decade for precious metals investing with Monex, featuring managing partner of CPM Group and author of the Monex Precious Metals Outlook Report, Jeffrey Christian.
Hello, my name is Sean Brasney, Sales Director for Monex Deposit Company. I'm here again today with Jeffrey Christian, who is the Managing Director and Founder of CPM Group. He's also the author of our New Decade for Precious Metals Investing Report, and of course our CPM Group reports on gold, silver, platinum, and palladium. Thank you for being with us here today, Jeffrey.
It's good to be back with you, yes.
I want to just bring up your CPM Group market commentary that came out today. Addressing, it was titled Gold Realism, and addressing all the chatter we see out there on the web of, gold going to $5,000, $10,000 an ounce. And boy, you just came out strong and to the point in this commentary. And I want to remind our listeners that if you haven't yet, please go to cpmgroup.com and sign up for their market commentary and their information, as the information is very refreshing. And when you start to get into real research and analytics, it's great to have that knowledge base at our fingertips. So again, thank you for that information.
You're welcome, yes.
That brings me to a point of another topic that tends to get a little bit oversimplified, and that's the dollar to gold correlation, where many people talk about, many investors talk about, when gold goes up, the dollar goes down, or vice versa. And as we know, that's really not that true. From mid to late 2018 until really the beginning of this year, gold and the dollar were holding somewhat of a positive correlation. Although that did slip here in March, where we saw the dollar spike up near that 103 and gold put in that low down at 1450, it seems we have a little bit more of a negative correlation now taking shape. And do you think that correlation will continue?
No, I think the negative correlation is going to slip away. One of the points that we always make is that gold trades against currencies, not the dollar. And if you look at the long-term statistical relationship between the dollar and gold, since gold prices were freed in 1968, it's about a negative 34% of correlation, which means a third of the time gold is trading in the opposite direction of the dollar, which means that in the other two-thirds of the time, it's either trading in the same direction or it's not trading in a correlated fashion. One's trading water and the other one's rising or falling. And I think what you're seeing is 2018, 2019, they were in a positive correlation, as you said. And what you saw was gold and the dollar are the two safe haven assets of choice around the world. And in 2018, 2019, people were buying both. In 2020, you've seen a shift, and what you've been seeing is that the dollar's moving kind of sideways to lower and gold is rising. So you've got people saying, in terms of safe havens, I prefer the gold right now to the dollar. So they've been buying gold and they haven't been buying dollars. And we think that's going to continue. So that we think that over the next year or two, what you're going to see is a correlation that's either zero or negative. Our inclination is the dollar kind of moves sideways for a variety of reasons in the international monetary system, and gold continues to rise, so that you have kind of a closer to a zero correlation. If we're wrong, we think the dollar falls and gold rises, and we have a negative correlation.
Also, in regards to the Fed, we've throughout the last several months, we've seen the Fed come in and be accommodative to the markets. I've also been reading some information about the Fed reducing its balance sheet, or what you and I have talked about in the past with quantitative tightening. And it can get a little bit confusing. And can you give us a little bit of a rundown as to where the Fed really is being accommodative, and maybe some other areas where we still expect them to divest of the balance sheet?
Confusion is universal right now. But in terms of the Fed, here's the way we look at it. The Fed will be as accommodative as it needs to be to keep the U.S. out of a recession, or a depression rather, and deflation. So I think the Fed, the overriding direction of the Fed is as much accommodation as is needed. Now you see little things where they're tightening here or they're tightening there or they're changing their rules on some of the asset purchases and programs like that. And as you and I have spoken, what we see that as sort of like a captain of a ship, running a little motor here, a little motor there to sort of keep the thing moving forward in the direction he wants. So we think that those little bouts of tightening are just really tactical moves, and that the overall strategy is to continue to be as accommodative as will be needed, and that is going to be extremely accommodative for the foreseeable future, the next year or two.
A lot of the news we see out there, or at least online, or the chatter, I like to refer to it as, is it has been talking about this accommodative position. Being somewhat aggressive is, of course, going to crash the dollar or crash the economy. And you've been real instrumental in helping us understand about the real dollar, the need for dollars around the globe. Do we still see that dollar demand happening moving forward here over the near term?
Well, it's interesting because we were looking at excess reserves at nationally chartered banks yesterday, and they're very high. They're higher than they were at the peak during the global financial crisis. I think they were about $2.8 trillion then, and they're about $3.2 trillion now. So you've got a tremendous amount of money that the Fed has pumped into the global financial system that's sitting in the banks, and that's a problem. If that money comes into the market, you could see some weakness in the dollar. But right now, what you've got is a world that's basically still very starved for dollars.
Great information, Jeffrey. Our time with you, of course, is always extremely valuable. Your information. Thank you very much for joining us today here. Also, for our listeners, please call in, talk to our account representatives, ask for the new Decade of Precious Metals Investing report, as well as our CPM Group reports for the research and analytics on gold, silver, platinum, and palladium.